Want to understand the stock market, but does it feel like some kind of a magic trick when Pete's Pizza Parlor around the corner suddenly turns into a huge, rich company overnight? How does this happen and why are there two markets involved? And why does the company only receive money in one of those markets? In this video, we'll break it all down. Intrigued? Then let's dive in. So why do companies need the stock market and why do so many people invest in it? Well, it begins with an entrepreneur, let's call her Alex, who has a business idea. Her venture starts small but steadily attracts a growing customer base. Eventually, demand of her products outstripped the production capacity of her single shop and manufacturing facility. To meet this increasing demand, she realizes the need to establish additional retail outlets and production sites. To accelerate this growth and outpace her competition, Alex requires substantial capital. However, her personal financial reserves are limited at this stage. The majority of her available funds are consistently reinvested into the business for essential operations such as inventory procurement and salary payments. Given this financial constraint, what options does Alex have? Well, with an established and operational business, she can seek to raise capital by offering equity to investors who believe in her company's vision. These investors purchase shares of the company, enabling them to participate in the company's prospective growth. Typically, those who invest at this early stage do so under particularly advantageous terms. This process is known as an initial public offering, or IPO in short. The initial public offering provides Alex's company with a substantial capital infusion. Concurrently, investors who acquired shares directly from the company in the IPO are satisfied as they secured them at the offering price and anticipate the ability to resell them profitably due to expected strong market demand. This initial issuance and sale of shares by the company to these investors occurs in the so-called primary market. Participation in this primary market during an IPO is typically extended to a range of investors, often including large financial institutions, pension funds, and other specifically invited parties. Following the company's public listing, these shares become tradable among the broader investing public on the secondary market. This transition offers the initial IPO investors liquidity and the opportunity to realize profits from their investments. The secondary market, widely recognized as the stock market, serves as the platform where investors buy and sell shares directly from one another. Given that Alex's company derives no direct financial proceeds from secondary market transactions, what is her motivation for ensuring its stock price remains high? Well, a high stock price serves as a high, prominent public indicator of the company's performance and its perceived market value. This positive perception in turn yields several indirect advantages for the company. It can bolster marketing efforts for its products, improve its ability to secure more favorable financing terms, and enhance its attractiveness to potential employees. In a theoretically efficient market, the stock price of a company like Alex's would be expected to directly reflect its financial health, moving in tandem with its revenue and profit. Yet, empirical observation often reveals a different reality where stock prices exhibit substantial volatility. These fluctuations can make the market feel like a wild roller coaster ride, often seeming disconnected from a company's underlying performance. This naturally leads to the question of why such market behavior occurs. Here are some of the main reasons why stock prices can be so active and don't always perfectly mirror a company's current financial report card. The first reason is the overall market mood or investor sentiment. Think of the stock market as being influenced by the collective mood of all investors. If investors are generally optimistic about the economy, new technologies or future growth, they tend to buy more stocks which can push prices up across the board, even for companies whose individual situations haven't changed much. Conversely, if there's widespread fear or uncertainty, perhaps about the recession or global events, investors might sell stocks, causing prices to drop regardless of one specific company's good performance. The second reason is news and future expectations. Stock prices react very quickly to news. This isn't just about current profits, but also about what investors expect to happen in the future. Company news, such as, for example, a new product launch, a major contract win, a scandal, or even a change in leadership, can make investors suddenly more or less eager to own the stock. Trends affecting the whole industry, like new regulations or a competitor's breakthrough, can also impact the stock. And economic conditions or events like changes in interest rates, inflation figures, unemployment numbers, or significant international events can also make investors adjust their buying or selling decisions rapidly. The third reason is simple supply and demand. At its core, a stock's price changes based on how many people want to buy it versus how many people want to sell it at any given moment. If many investors suddenly decide they want to buy a particular stock, perhaps because of good news or positive sentiment, but fewer people are willing to sell, the buyers will have to offer a higher price to get those shares. The opposite is also true. If many people want to sell and fewer want to buy, sellers might have to accept lower prices. All the factors above, company performance, news and mood, contribute to this constantly shifting balance of buyers and sellers. So while a company's solid performance is a crucial foundation, the daily and weekly stock price movements you see are often a result of this much broader mix of news, expectations, overall investor confidence, and the resulting tug-of-war between buyers and sellers. So, to recap, the primary market is where Alex sells initial shares to selected investors that believe she will have success with her business. The secondary market is where investors like you and I will buy and sell those shares among each other. Alex has an incentive to keep the stock price high as it's good marketing for her business and makes it easier to get loans to grow her business further. Also, she would get more money if she decided to sell her business as it is perceived to be more valuable. And the stock price fluctuates based on the current performance of her company, the future outlook, and overall market conditions. And that's it. I hope this video was valuable to you. If yes, then please give it a like and consider subscribing if you want to see more content like this. Have a good one and see you in the next video.